Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is co-founder and head of investor relations at Donis Investment Group, Jeffrey Donis. Jeffrey did his first real estate deal when he was still in college and then went against his mother's wishes to drop out and pursue real estate investing full-time. Today, he and his team, which include his two brothers, focus on value-add multifamily properties in the sunbelt states. In just a few short years, his group has been able to build an impressive portfolio of multifamily assets in some key markets and have plans to continue their growth trajectory. And so with that, guys, it's an honor to welcome my guest for today's show, Jeffrey Donis. Jeffrey, how you doing, my friend?
Hey, Kevin. Doing well, man. Can't complain. Hope you are.
Yeah, doing great. Excited to have you here. Excited to dive in and pull back the curtain of your business and just learn a little bit more about you and your brothers and your firm. And so maybe for those that we'll start with for those that aren't familiar with you and your story, maybe take a few moments, kind of fill in the blanks of the bio that I provided in the beginning, and tell us a little bit more about yourself, your background, and ultimately how you found your way into the real estate world.
For sure. And thank you for having me on the show. I'm really happy to be here. So my name's Jeffrey Donis. I am currently 21 years old. I got into real estate about 3 years ago when I was a freshman in college. Growing up, I grew up with my single mother, so come from a low-income background, and I always knew that I wanted to help my mom and really just help myself be in a better position financially. When I was older, didn't really know what that looked like, so that's why I went to college after graduating high school to pursue more of a traditional route in the sense of getting a degree and then going to get a job. That's how I thought of money, really, was to get a degree, get a job, and that's how I was going to make my money. Eventually, when I was a freshman, I read the Rich Dad Poor Dad book, which was pushed on to me by my older brother, who was 3 years older than me. And after reading that book, it really opened the doors to more of a non-traditional route when it comes to education and to pursue in different methods to pursue financial freedom, which was what I was after. So I learned about real estate through that book, and then I started listening to podcasts. Fast forward that first year, we got into single family investing, primarily wholesaling, and then we learned how to do creative financing, which we were focused on two main strategies, subject to and owner financing. So we ended up joining a mastermind group in that space, which taught us how to do that. So after the first 13 months of doing it, it took us 6 months to do our first deal. 13 months in, we had done about 15 deals, mainly wholesaling, and two creative finance deals where we were actually able to take ownership of two single family houses here in North Carolina. I live here in Durham. And after that, that was when we learned about apartment syndication. So we took a similar approach in the sense of joining a mastermind group. And since then, after joining that group, which was 2 years ago, we've been able to get into about 5 apartment deals, 4 as co-general partners and 1 as a lead sponsor. And that's how we got to this point.
Okay, well, that's exciting. I appreciate the insight there, and let's talk about that. The first couple of deals, and I guess more specifically, again, you had mentioned your two strategies initially in the single family space were wholesaling, and then creative financing, and that meant subject to or maybe owner financing strategies. And so, at what point in time you did 15 deals? Again, 2 of those being creative financing, and then the rest being wholesale. At what point in time did you, and for what reason? Did you decide to make that pivot from, again, what you had kind of put a year plus effort into and say, hey, maybe this isn't right, maybe this isn't the fastest approach to take, maybe there's a better way, or whatever the reasoning was on your side. Tell us about that, and then ultimately, what did that transitionary period look like?
Yeah, from the single family space into multifamily.
That's right. That's correct. Yep.
Yeah, so my brothers and I were in a few different mastermind groups at the time for single family, and there was a developer who came on who was syndicating his development deals, and we had heard about syndication through different gurus on social media like Grant Cardone, and we were listening to his content, and he kept saying go bigger sooner, and he wished he would have started in multifamily earlier. So that was already a seed that was planted. It just hadn't sprouted yet. So we got on that call. It was like a Tuesday afternoon, and we were listening to this developer who was syndicating his deals speak about syndication. And he was just telling us that if he could do it, we could do it. So we got inspired by that, which led us to asking ourselves the question, why are we still in this space if we don't really want to be here long term? And we didn't want to do what a lot of young entrepreneurs like ourselves do, which is chase the shiny object syndrome, or I guess get contaminated by that, right? We start chasing different things. but we really just asked ourselves that question, and we realized that our goal ultimately was to end up in commercial real estate. So we started looking into the reasons why we should go bigger sooner, which were one, the scalability of it, two, there's less risk, three, from our eyes, we were already spending all day every day working. Why not build something that we wanted to do long term? And we thought we would enjoy it a lot more. We really didn't enjoy what we were doing in the single family side because it was so transactional. With multifamily, you buy one property, it's 100 units, it's one closing. For single family, to get to 100 doors, you're going to have to close on 100 different properties, find 100 different deals, deal with 100 different sellers. So all of that really turned us off from it. So that's really what flipped the switch. And then we actually ended up asking one of our mentors at the time what he thought we should do. And he kind of just pushed us towards doing whatever we wanted to end up doing, which was commercial real estate. There was a lot of things holding us back, but we were able to overcome those limiting beliefs. And then we got into it.
Okay, fantastic. And talking about some of the hurdles, again, transitioning from the single family stuff over to larger multifamily. Again, the first couple of deals that you guys did, you guys acted as a co-GP, and then recently did your first lead sponsor deal. But talk to me about some of
Yeah,
what were some of the biggest challenges, from maybe capital raising to just mindset shifts. I mean, what were some of the big hurdles you had to overcome?
for sure. So initially, obviously, I'm young and it was new, so there was a lot to learn in regards to the terminology and different minute details of explaining what a syndication is and versus underwriting like a simple single family deal and then looking at a large apartment complex. There's a lot of different things that you have to learn. So that was the first thing was education. Second was my age. Obviously, being young when it comes to raising capital and having people invest with you, there's a lot of people, and I thought this myself. They'll think that because you're too young, people that are a lot older who typically have enough money to invest aren't going to want to invest because they don't trust you. So that's one limiting belief that I had. Three was that I didn't know anyone. My network right now at that point was limited when it came to the commercial side of real estate. It was all single family, fix and flippers, buy and hold investors, people like that. So that was another limiting belief we had. And I guess me being a minority never came into the picture. I just never really thought that way, but that could be a lot of people in your audience might have that limiting belief
Mhm.
as well. Whatever it is, that's all the things that we faced going into it, and how we overcame it was one, we educated ourselves. So we started reading a lot of books. The first book I read was the best ever apartment syndication book by
Mhm.
Joe Fairless. We treated that like a textbook, broke it down, made some actionable steps. Second thing, and this comes to the point of me actually being successful at raising capital, was starting to build my credibility. And I did that through my online presence. So we started posting a lot of social media content, which we still do to this day. And we also created a website. And then we created a podcast and we started releasing podcast episodes. So with all of that going on, we were interviewing people in the space, networking, posting it on LinkedIn, rubbing shoulders. We like to call it. There's like social, like you're pretty much. I post a picture with Ken McElroy or Robert Kiyosaki, and people start to associate us with them. So slowly you start to build your capital, if you will, like social capital
Mhm.
over time. And on top of all this, we were taking a lot of action, and we had a little bit of profits that we had from our single family business. So when it came to really enhancing our network, we joined a mastermind group called Think Multifamily, which allowed us to have access to different key partners who then, when they were on my team and they'll actually partner with me on deals, I now had the ability to talk to my investors with the confidence of having someone on my team who's done lots of multifamily deals and has been in the industry for a long time. So all of these things helped me not only build the confidence, but have a track record when it came to speaking with investors, brokers, etc.
Yeah, fantastic. No, that's great. I appreciate that. And so let's talk about, again, the first phase, I would say, of the multifamily journey. And that's, well, I guess
Yeah.
maybe it's the second phase. First phase is getting educated and just understanding the basics. Second phase is actually doing deals, taking action, doing deals. And so, again, you had mentioned that, again, your social network and that social capital, like you were building that, you're working on expanding your network. And so, you just didn't really have the ability for a multitude of reasons to maybe be a lead sponsor on that very first deal. And so you just
Mhm.
base it, co-GP'd with other experienced operators, folks that have been doing it for a number of years, until you got to the point to where you actually could do your own deal and act as lead sponsor. And so, maybe just for those that might understand what the difference is there, and maybe the mechanics behind the scene, like what is the difference of being a co-GP in a deal versus being the actual lead sponsor of a deal?
Yeah, so for as a co-GP, you're typically partnering with other partners who are considered lead sponsors, and those lead sponsors typically are the ones who actually found the deal from submitting all the LOIs and then one getting accepted. A lot of times they're also signing on loans. They're pretty much playing a role in all aspects of the deal. Typically, they don't have to be, but in a lot of times they are, and they're really running point. So, sort of running the shots, and I guess is the captain of the ship. As a co-general partner, you're still an active investor and an active member of the team, but you're not necessarily leading the team, or the captain, maybe a co-captain. And typically there's different rules that co-GPs can play. Obviously, they all have to be active and some type of active role, whether that's helping out with construction, asset management, investor relations, etc. But they're for a lot of deals that I've been a part of, we're also helping with raising capital. So that's one of the biggest values that a co-GP can bring to a lot of deals. Now, as a lead sponsor, you're from the day one of you actually finding the deal, you have to go through talking with lenders, getting insurance quotes, finding your property manager, vetting them, finding the deal, underwriting the deal, performing due diligence. And then typically for our deals, our lead sponsors are always on the asset management team. So you're obviously executing your business plan, coming up with the business plan initially, et cetera. So there's a lot more responsibility and a lot more on I guess on the table in regards to what has to be done from the lead sponsor's perspective than being a co-GP.
Okay. And what are some of the benefits of actually being the lead sponsor? Again, is the profit split? Is it greater for the lead sponsor than that of the co-GPs, or how's that broken up?
Yeah, so I think it might be a little subjective for
Mm-hmm.
me, in my opinion. What is a benefit of being a lead sponsor is you have more control over what happens with the deal, and specifically with how you communicate with your investors, for example. You'll obviously be perhaps the one that's very, very active, knows exactly what's going on all the time because you're the one doing it. So you might have better communication when it comes to your investors, or you're the one that's actually determining what's happening on the business plan. So I think that is a benefit. Now, a potential downfall to it is you have more of, I guess, responsibility, which means that a lot more time is going to have to go towards each deal versus a co-GP may be able to do a co-general partnership on 3 different deals, while you can only be a lead on one because of the
Mm-hmm.
amount of time that you have to put towards
Yeah.
that one deal.
Yeah.
But there's another benefit of potentially making more money in regards to where
Sure.
you're going to be compensated.
So talk to me about, obviously you just acted as your first lead sponsor in a deal. We find ourselves in some volatile markets. The capital markets are all over the place. Seller expectations haven't necessarily yet adjusted to some of the changes in the in the real estate marketplace. And so again, just there's a lot of uncertainty out there on many different levels. Talk to me about this, this last deal you just did, which was the first deal you're acting as lead sponsor. Maybe some of the challenges you guys faced with getting this one to the closing table, and then maybe also let's do like a high level case study. I know it's not a full cycle deal yet, but let's talk about the opportunity at hand. What excited you about the deal? Was it location? What's the business plan look like? Is it a value add deal where you're going to go in and enhance a number of the units, and then what's the long-term play? So just again, 10,000 foot view of that
Yeah,
particular
yeah,
deal, if you could.
for sure. So in regards to the deal and us finding it, it was in Atlanta, Georgia, which is I live here in Durham, so I'm about 6 hour drive from Atlanta, not far at all. A lot of the Southeast is obviously experiencing growth with
Mhm.
the population growing, different jobs coming in, especially Atlanta. It's seeing a spike in different tech companies moving in. Apple's looking at creating an office there. So is Meta, and obviously other big companies like Amazon already have office space there and are currently located there. So that's really good for our residents and just people in that part of Georgia. In regards to the deal itself, we found it from a broker who initially sent us the deal. We underwrote it, got under contract, and this was in June. So right before the Fed started raising rates,
Okay.
which was a very, very, I'm sure, Kevin, you had some experience raising capital or doing something during that time. A lot of people were scared because they didn't know what was going to happen with interest rates,
Mm-hmm.
and for good reason, because it turned out that they obviously raised rates and they raised it very rapidly. But at that time, we were struggling getting lenders to give us quotes. We were struggling to get investors and partners on board for various reasons, but mainly because they were uncertain with what was going to happen in the economy. We ended up getting it done. We raised a little over closer to $10 million on that deal. It took us a lot longer than we thought it would, but I was just talking to my peers, and I'm sure you heard about this going on in your network as well, with people losing earnest money and
Hmm.
different deals falling out of contract and things like that, which obviously was a possibility for everyone, including us. But we were just thankful to get it done. We also had earnest money on that one, so definitely didn't want to lose it. But once we got it done, now that closed November 15th is when we closed on that, which took a long time, as I mentioned.
I was
It
say,
was
yeah, it's 5 months.
yeah, like it was every single day kind of, not sure whether it was going to happen or not, but we just kept pushing. So eventually got it across the finish line. And now in regards to just projections and what we plan on doing with the asset, it's a little under 200 units. It is a C-class property, and we're looking to go in and renovate about 80% of the units. So that's about, let's say, a little over 100 of the units we're going to renovate. Um, in regards to adding amenities, it is a C-class property, so we're not going to go do these high-end finishes. It's more so adding a dog park, adding a playground. The current laundry facilities there are down and not in the best condition, so we'll go in and renovate those. The current leasing office is used it's within one of the rentable units. So what we plan on doing is converting one of the laundry facilities into a leasing office, so that way we can rent out the other unit. All of these renovations and projects are with the intention of hopefully increasing the overall community and just the living conditions of our residents. So that way it just is a little bit more of a justification for us to increase our rents to market, because we are under market rent at this point.
What type
Uh,
of delta is there on the current market rents to where you think market is?
so I'd say anywhere from $200 to $300 on the high end, but anywhere on average, I'd say 150 to 200 per
Okay.
unit. In regards to hold period for us, we're always typically shooting for a 5 to 6 year hold, and then we don't have to go into returns necessarily, but we like to be, I'd say, pretty in alignment with what the industry averages are, depending on the asset class. So for us now, moving forward, what we're looking for are more of a Class B product, so higher than 6% cash on cash, 15% or higher IRR, and that's pretty in alignment with what we're doing on this one too.
Okay. And what type of debt, when it was all said and done, what type of debt were you able to actually secure on the property? Is it bridge debt to allow you to execute the business plan, or
Mhm.
ultimately where'd you end up?
On this one, we got it was a bridge loan, which obviously a lot of people are scared of right now, but we were able to purchase a rate cap. It was very expensive. I want to say close to $1 million is what we spent on it. But we obviously budgeted for that going in, so that still made our numbers work with the rate cap included. And it's been so long that I looked at the debt in regards to the terms, but right now we're locked in at 6.6%,
Hmm.
which isn't anything crazy. I think long term right now you're looking at 5 to 5.5 fixed. So we were at about 6.6 on the bridge, which 3 year +1 +1. So two options to extend.
Got it. Got it. Okay. Fantastic. And then so ultimately the business plan will you'll look to execute the business plan and then start maybe looking for an exit somewhere, year three and consider maybe holding you can keep that bridge loan in place should you need it
Mhm.
for 5 years. But I guess or would the plan be to execute the business plan in the first couple of years and then put longer term debt in place, and then ultimately the sale would probably require more of a assumption from the seller once your term comes up or once you're ready to exit out of it? Or again, what's like plan A and plan B on the back end?
Yeah. Yeah, so there's multiple things we can do in regards to year three. Obviously, refinancing if it makes sense to in that current environment. If it's not a refi, then we have two options to extend as long as we meet the lender's requirements, which are just subject to how the property's performing at that point. In regards to, let's say we are able to refi into a long-term debt, then we would hold on to it up until 5 to 6 years is the projection. But if we are able to again refi at year 6 or year 5, then we would hold on to it after returning our investors' capital.
Got it. No, fantastic. And talk to me about what the future holds. Just the growth of the company. What do the next 5 years look like? Show me that roadmap.
Yeah, so this year we're looking to do 1 to 2 deals a quarter. Right now, deal flow is picking up. It was a little slow towards the end of Q4 of last year, but we're seeing more deal flow, and nothing. No, most deals aren't penciling out, which isn't a good thing. But
And how
that just
how 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 far off are you seeing? I mean, deals that actually even
Yeah.
if they pass the first muster, right? Like, just, I
Mhm.
know you've got like a, high level screening, but or maybe the high level screening, that's where most of them are just getting thrown in the trash can. I mean, how big of a delta are you seeing on average from what you think realistic value should be to, what the broker's target is?
So lately we've been seeing, I'd say the closest we've gotten has been 10% of what the listing price is.
Hmm.
On average 20% off of what they're asking. Now, I would say everyone says this, right? We're conservative with our underwriting, but we've looked at what other people and how are making these deals work, and certain things like economic occupancy, um, in regards to things like that, we're looking at 10% every single year. We don't adjust it regardless of what year we are in our business plan. Other people are able to make those numbers. I guess they decrease it over the whole period. So let's say you start at 10%, you go down from 10 to 9 to 8, 6, etc. We don't do that. We just do 10, 10, 10, which I think is pretty conservative, which it's a good thing in regards to if you're able to hit your numbers. You're being obviously pretty conservative, but it also makes you less competitive when it comes to submitting offers. So that could be a reason why we're so far off. But right
Hmm.
now, I just tell my brother does underwriting. I just tell him, look, man, there's going to be more opportunities. We need to be patient, and I don't want to have to go into a deal and assume we're going to have these, hard, really good years when we don't know what's going to happen. So
That's
on
right.
the front end, we can just buy right. Then I think that's a smart thing to do. But I'm
Absolutely.
confident we'll start seeing more deals that pencil out.
You guys got a long road ahead of you, plenty of time to
Right.
be patient and just buy the right deals. So I agree with you there. Jeffrey, for those that want to learn more about you and your team and what you guys have going on, where's the best place to find you?
Yeah, you can visit our website, www.donisinvestmentgroup.com. Also, if you'd like to check out our free checklist that we like to give out to anyone who's interested in vetting different passive investment opportunities, feel free to visit this link, www.donisinvestmentgroup.com/checklist. And then you can visit us on social media at Donis Brothers on all platforms.
Okay, fantastic. And guys, we'll be sure to put all that in the show notes as well. And Jeffrey, it's been a pleasure having you. Thanks for joining us here today.
Thanks for having me, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.